people think that the stock market is fair and stock prices move naturally. Well, they can't be more wrong. Every second, powerful players in the stock market are making moves that the average investor cannot predict. And if you don't know the rules that these big players go by, then you are just another pawn getting ready to be wiped off from the market. Today, in part 2 of our Basics of Stock Market series, what you are going to learn in this video is going to change the way you see the stock market forever. Have you ever wondered how big a company really is? Here, I'm not talking about how many employees are working for a company or how many buildings do they have. Here, I'm talking about how much a company is worth in the stock market. That's where something called market capitalization comes in. Market capitalization is the total value of the company's shares in the stock market. It's like asking, if I wanted to buy this whole company at today's stock price, then how much would it cost me? The formula for calculating market capitalization is quite simple. You just have to multiply the current share price with the total number of shares which is currently available in the stock market. Generally, market capitalization helps investors to compare the size of a company with other companies in the same industry. So, if you are trying to figure out whether you are investing in a small startup or in a tech giant, looking at the market capitalization of these companies will give you a quick snapshot of their size in the market.
Ever open your trading app and think, why is this stock moving up or tanking? It happens to me all the time. 1 minute you're up, next minute, bam, down 5%. So what really moves stock prices? Let's break it down. At the core, it's simple. Supply and demand. More buyers than sellers? Price goes up. More sellers than buyers? It drops. Just like a seesaw, whoever outweighs the other wins. But wait, there's more. Reason number 1, company news. Maybe a company crushed its earnings, launched a killer new product, or oops, their CEO just quit. Anything that changes how people feel about the company can send the price flying or falling. Reason 2, the economy. Inflation, interest rates, jobs data. These are the big picture signals that make investors rethink everything. If the Reserve Bank of India raises rates, stocks might wobble. Bad jobs news, investors could head for the exits. 3 future expectations. Here's the twist. Stocks don't just move on what happened, but on what everyone thought would happen. Company beats earnings, but everyone expected more? The price can drop. It's all about surprise versus expectations. 4 big players: hedge funds, pension funds, huge institutional investors, even governments. When these guys move billions, the ripple effects hit everyone, including you and me. And yeah, sometimes it's just emotion. Fear, greed, a viral tweet or a rumor on Reddit. That's all it takes for prices to explode or crash. So, next time your stock jumps or dips, remember, it's not random. It's a mix of news, the economy, big players, expectations, and honestly, a whole lot of psychology. The market's unpredictable, but now you know what's behind those wild swings.
Have you ever wondered who the real players are in the Indian stock market? It's not only you who is clicking to buy or sell in his trading app, but there are a whole host of other characters who are behind the scenes. Firstly, we have the retail investors. These are everyday investors like you and me. They invest small amounts to grow their wealth. Then there are high net worth individuals. These are wealthy investors who occupy privileged positions in society. In the Indian context, HNIs or high net worth individuals are those investors who have a minimum investable corpus of at least 5 crore. These investors often influence market trends as they have a lot of money to invest in the stock market. Next up, we have the giants like insurance companies, pension funds, mutual funds, etc. These are collectively known as domestic institutional investors. These investors invest crores of rupees on behalf of millions of clients. On the international side, we have the foreign institutional investors who invest in the Indian stock market. They pump in big money into the market from abroad. And when these investors move, the market really reacts fast. Then we have the stockbrokers who are our gateway to the stock market. They connect us to a stock exchange, as anyone who wants to buy shares needs to mandatorily open a demat account with a broker. And then we have the market makers who ensures there is always someone to buy and sell shares and provide liquidity in the stock market. Overseeing it all is SEBI, the Securities and Exchange Board of India, who is the regulator of the Indian stock markets, keeping things fair and transparent for all. Have you ever heard people saying that investing and trading is the same thing? Well, they're actually quite different, and knowing which one fits you will actually save you a lot of money and stress. Investing is like planting a tree to buy a stock or a piece of a company and let it grow over time. You are not checking the stock price every 5 minutes or every day while you are investing. Whereas in trading, you take a much more hands-on approach where you are looking to make money from short-term price fluctuations. Sometimes traders are in and out of a stock within a day or a week. It's a more hands-on approach, and yeah, it can be a roller coaster too. Neither investing or trading is better. If you love action, if you can stomach a lot of risk, then trading is for you. But if you want to create wealth slowly but with higher probability, then investing is the way to go for you. To put money in stocks through investing, we have to perform a thorough fundamental analysis of the company before investing. But in trading, we perform a technical analysis of the company. In investing, we look at the financial statements of a company like balance sheet, profit and loss account, cash flow statement. Also, we analyze qualitative factors in investing like management of a company, the business model of a company, or the growth prospects of the company. Whereas in trading, we analyze the price chart of a share. We also use certain technical indicators to analyze these price charts for trading. First of all, start with education and not emotion. Don't invest in stocks just because everyone is doing it. You should first try to learn the basics like what is a share, how does the stock market work, what moves stock prices, what is the risk of investing in shares. Also, you need to grasp the basic concepts of technical analysis and fundamental analysis before risking your capital. Begin with a smaller amount. Even 3,000 to 4,000 rupees is enough to start investing in the stock market. Focus on learning and not earning in the beginning. You should not expect to double your money overnight. Compounding works like magic, but it needs time and patience. Third point is, you should always do your own research before investing. Never invest based upon a random tip or a WhatsApp message. Study the company's financials, its products, its management, and growth prospects before investing. Losses are part of the game. Even the best investors have bad days and suffer losses. Even renowned investors like Mr. Rakesh Junjunwala earned most of his wealth from a few stocks like Titan, Crisel, VIP Industries, etc. But most of the stocks in his portfolio did not give very high returns. So, if you could select few good stocks to invest in, then it should be enough to create a lifetime of wealth. You should be aware of the latest stock market news, but you should not be driven by it. Stay updated through sources like Money Control, Economic Times, but you should avoid overreacting to every headlines, because for a stock to give you very large returns, it will go through different phases of up cycles as well as down cycles. Investors who are new to the stock market should try to avoid penny stocks and futures and options, because penny stocks are very volatile and they are prone to manipulation, whereas futures and options are for advanced traders only. Last but not the least, you should never borrow money to invest in the stock market. Even the most astute investors who invest in some of the most stable and reliable companies are susceptible to losses, because it's impossible to predict the direction of the stock markets in the short term. The shares are held for more than 1 year, then up to a gain of 1,25,000, there shall be no tax. But if the amount of gain is above 1,25,000, then it will be taxed at the rate of 12.5%. On the other hand, if we sell the share before 1 year, then the gains will be taxed at the rate of 20%. A share certificate is a written document which is issued on behalf of a company. It acts as a legal proof of ownership stating the number of shares held by an individual or an entity. The Securities and Exchange Board of India, which is the regulator of the Indian stock market, has mandated that every company must issue a share certificate to keep a record of the ownership of its shares. Share certificate में आपको कंपनी का नाम, उसका registered address, उसके अलावा आपको शेयर होल्डर का नाम, उस पर्टिकुलर शेयर होल्डर के पास कितने शेयर्स हैं, उसका क्वांटिटी, उन्होंने कितना पैसा देके वो शेयर्स खरीदा है, वो अमाउंट भी आपको शेयर सर्टिफिकेट में मिल जाएगा। Today we are going to break down 3 common type of orders to buy shares in the stock market. You should keep in mind that first you need to open your trading app in your mobile to execute these orders. So, have you ever looked at your trading app and wondered? First up, we have the market order. Now, this one is the simplest of all the orders. Investors who use market order are basically saying, I want to buy this stock right now at the best possible price. So, if Reliance Industries is currently trading at rupees 2000 and you want to buy shares in Reliance through market order, then the order will go through immediately, but you don't have control over the exact price at which you will get the shares. So in this case, you may get the shares at a price which is little higher than the currently traded price of rupees 2000. Next up, we have the limit order. Investors who use limit order are telling the market that I want to buy these shares at this particular price only. So if Reliance Industries is currently trading at rupees 2000 and you have put a limit order to buy shares at rupees 1800, then the order will execute only if your shares price falls to rupees 1800 or below. And lastly, we have the stop loss order. Think of it as your safety net. Let's say you have bought a share at rupees 100 and you set a stop loss order at rupees 90. So if the share price falls to rupees 90, then the stop loss order will turn to market order and the shares will be sold immediately at rupees 90. This will help you to cut your losses before it falls any further. Now I shall give you some book recommendations which will increase your investment knowledge to the next level. First up is Intelligent Investor by Benjamin Graham. This classic investment book was first published in the year 1949 and is still considered as the Bible for all investors. This book emphasizes the importance of long-term strategies over short-term speculation. Benjamin Graham introduced the concept of Mr. Market to illustrate market irrationality. He also advocates for a margin of safety approach in investing to minimize risk. Another great book for all beginner investors is The Little Book That Still Beats the Market by Joel Greenblatt. In this book, Greenblatt emphasizes upon a simple rule-based investment strategy called Magic Formula. It emphasizes on buying good businesses which have high returns on capital at bargain prices. This strategy is easy to follow for any new investor and is designed for long-term success. Next up, we have the Warren Buffett way. Now, Warren Buffett is the richest investor in the world today. He is also the chairman of the biggest investment company in the world called Berkshire Hathaway. He looks for businesses which are strong, simple, as well as well managed. He buys stocks that are undervalued and holds them for the long term. Some of the stocks in his portfolio has been there for more than 10 to 20 years. Buffett avoids following market trends or short-term hype. Even when everyone was investing in technology companies in the US stock market, he was avoiding these companies as he could not understand their business model. Investment Checklist by Michael Sherman. This is a book with more in-depth investment knowledge than the other 3 books that I have just mentioned now. Only after reading the 3 earlier books you should read this book, as you will be introduced to advanced concepts in this book. This book is a practical guide to evaluate investment opportunities through a systematic checklist-based approach. It emphasizes understanding how a business operates, assessing the integrity and the competence of management, analyzing financials, and identifying potential risks.